Here's what this looks like in practice. Two buyers, same house, same week. Buyer A gets pre-approved in 8 minutes on a mortgage app. She submits a $590 offer with her $650 letter attached. The listing agent calls the lender's 800 number. No answer. The seller goes with someone else. Buyer B spends 3 days getting a fully underwritten approval. She requests a custom letter showing only $590. The listing agent calls the loan officer and gets a call back in 20 minutes. The seller accepts Buyer B's offer at $600,000, $10,000 more than Buyer A offered. Buyer B has a house. Buyer A is still searching. So save this video right now, because I'm going to tell you exactly what Buyer A got wrong, what her letter actually said, and the 5 traps inside a pre-approval letter that most buyers never see coming. Okay, so let's start with what a pre-approval letter actually is, because most buyers assume it means more than it does. There are 3 levels here, and they are not the same thing. Level 1, pre-qualification, based entirely on self-reported numbers. The lender does not verify a single thing. No documents, no credit pull, no review of anything. Buyers can answer those questions with the truth, with guesses, or with completely made-up numbers. Sellers know this. Most will not accept an offer backed by a pre-qual alone. Level 2, standard pre-approval. Documents reviewed, credit pulled, loan officer signs off. This is what most buyers have. It's the acceptable baseline in most markets. Level 3, fully underwritten TBD approval. A real underwriter has reviewed your complete file before you've even identified a property. This is the strongest letter you can bring to any offer. We're coming back to this one in detail. Now, here's what the CFPB actually says about the standard pre-approval letter, and I want you to really hear this. They use their own plain language definition, that it just says a lender is willing to lend to you, pending further confirmation of details. That's it. It is not a guaranteed loan offer. Full stop. And here are the 5 words that signal a weak letter, based on information provided by borrower. If those words appear anywhere in your letter, a savvy listing agent reads that as, "Nobody checked this." That's what Buyer A had. And that's trap number 1. Okay, trap number 1. And this is the one I see cost buyers the most, in the most competitive situations, over and over again. A standard pre-approval letter states your maximum loan amount, not the amount of your offer. Your ceiling. So here's exactly what happens. You're pre-approved for $650,000. You find a house, you love it, you offer $590,000. You attach your letter. The seller's listing agent opens that letter and sees $650,000. They now know, with certainty, that you can pay $60,000 more than you just offered. Block and Scarpa put it plainly in May of 2026, saying that if the seller sees that higher approval amount, they may assume you have plenty of room to increase your offer, and that suddenly your negotiating leverage becomes weaker. And it's not just the price. Sellers who see your ceiling become less flexible on repairs, on concessions, on closing costs, because they know you have room. Your own letter told them. So here are 3 fixes, and your lender can do all of them. Fix number 1. Call your lender before submitting any offer and ask for a custom letter matching your offer amount exactly. This is very common. Lenders do it regularly. They will not push back. Fix number 2. Ask for a letter tied to the specific property address with no purchase price stated at all. The letter simply confirms you are approved to purchase the property at that address. Amount not mentioned. Fix number 3. Request multiple letters at different price points. If you're going into an escalation clause situation, you want letters ready at different numbers, not just one. And here's the rule that ties all 3 together. Kiami Real Estate said it directly, that the timing of the disclosure means everything, and that it is unnecessary to disclose the pre-approval letter for a higher loan value than the sales price. Never show the full letter before offer acceptance. Your agent controls the timing. Make sure they know that's the plan. Trap number 2 is harder to spot. Okay, trap number 2. This one is harder to catch because the letter looks identical. In 2026, fintech platforms and mortgage portals can issue a pre-approval letter in 8 minutes. One click. It looks exactly like a real pre-approval. Same font, same logo, same language. But here's what it's actually based on: self-reported data, or a soft credit pull that doesn't verify anything. Annie Mac said this directly in August 2026, that many fintech platforms now offer one-click pre-approvals that rely almost entirely on self-reported data, that in 2026, many letters look identical at first glance, and that the underlying weight of the approval varies wildly. That was buyer A's letter. 8 minutes, self-reported. The listing agent called the 800 number on it and got nobody. Now, I want to be careful about how I characterize this because calling it fraud isn't accurate. What I can tell you is that the Washington Department of Financial Institutions and the Pennsylvania Department of Banking and Securities have both taken the position that issuing a pre-qualification as a pre-approval is a misrepresentation if the loan isn't ready to close as described. That's the regulatory view. It's not universal fraud, but it's a problem. So here's how you spot a weak letter before you submit it. 6 signals. The word pre-qualified appears anywhere, even in a footnote. The phrase based on information provided by the borrower. No loan officer NMLS number. Letter issued within minutes of applying. No expiration date. Annie Mac's own guidance says if there's no date, it's a red flag. And when a listing agent calls the number on the letter and nobody picks up, know what your letter is before you send it. The listing agent will find out either way. Trap 3 is about time. Trap 3, the expiration clock. Most pre-approval letters expire in 60 to 90 days. 90 is the most common standard, aligned with the 120-day shelf life of a credit report. FHA, VA, USDA, and conventional guidelines all permit up to 120 days. But each lender sets their own internal cap. Here's why the timing matters. NAR data shows buyers spend roughly 10 weeks searching. A 90-day letter timed at the very beginning of that search could expire right when you're ready to make your strongest offer on the house you actually want. When a letter expires, you resubmit documents and authorize a new credit pull. That's typically a hard inquiry, and hard inquiries temporarily reduce your score. Estimated at 2 to 5 points in most cases, not a guarantee, but real. Now here's how to shop without compounding the damage. The CFPB confirms this. Multiple mortgage credit inquiries within a 14 to 45-day window, depending on the FICO scoring model version, count as a single inquiry. Rate shop within that window. And here are the 5 things that can reduce your approved amount at renewal. New debt. A job change or income disruption, reduction in down payment funds, a drop in credit score, and higher interest rates since your original approval because a rate increase shrinks your buying power at the same debt-to-income ratio. Check your expiration date carefully. It's usually in the footer. If it's not there, call and ask directly. Trap 4 is the one nobody warns you about. Trap 4. Your pre-approval letter is not a rate lock. I need you to hear this one because it catches buyers off guard. Your pre-approval shows you qualify for a loan at the rate that existed when the letter was issued. That rate is not guaranteed. It is not locked. And in 2026, that matters more than it has in years. Here's the real-world volatility this year. The 30-year fixed moved from below 6% in February to above 6.65% by August. That's more than 65 basis points within a single calendar year. Fellowship Home Loans, citing Freddie Mac data, put it directly that rates can and have moved by more than 40 basis points within a single month multiple times during 2025 and early 2026. A rate lock only becomes available in most cases after you have a signed purchase agreement. Standard lock periods run 15 to 60 days. Average time from application to closing in Q1 2026 was 44 days. Now here's an option worth knowing, though I'm flagging it as an industry practice, not a standard product. Some wholesale brokers and lenders offer lock-and-shop programs that let you lock a rate before identifying a property, typically for 60 days, sometimes with a float-down option if rates fall. Ask your lender if this exists in their current lineup. And here's a worked illustration, explicitly labeled. A buyer pre-approved at 6.2% who closes 6 weeks later at 6.7% on a $400,000 loan loses approximately $130 a month. That's about $1,560 per year relative to what the pre-approval implied. Same buyer, different rate, different life. Trap 5 is about the builder. Trap 5. The builder's preferred lender. If you're buying new construction, the builder will likely require you to get pre-approved through their preferred lender before you can sign a contract. They'll frame it as vetting your financing, and then they'll offer you significant incentives to use that same lender for the actual mortgage. Closing cost credits, upgrades, appliance packages, extended rate locks. Here's the legal line, and I want to be clear. The CFPB confirms builders cannot legally require you to use their preferred lender. That violates RESPA. What they can do legally is offer incentives to encourage it. Offering is not requiring. That's where the law sits. Now here's the conflict of interest. Preferred lenders often have financial relationships with the builder. The lender's primary loyalty is to maintaining that relationship. Your rate may not be their first priority. In Q2 2026, new build lenders were offering an average of 5.85% versus 6.47% for existing homes. That looks like a big advantage, but I need to flag this. That gap is significantly driven by builder-funded buy-down programs, not necessarily by the lender's market rate competitiveness on its own. So here's the fix. Get the builder's pre-approval to satisfy their requirement. Then simultaneously get a loan estimate from an independent lender. Compare total costs over 5 years and over 30 years. A $5,000 closing credit evaporates quickly against a 0.25% higher rate over a 30-year loan. Get both. Then decide. Okay, so let's go back to the two buyers from the intro because now you understand what actually happened. Buyer A had a pre-qual dressed as a pre-approval. She showed the seller her ceiling. The loan officer's number went to voicemail, and she offered $590 on a house the seller was willing to take $590 for, and she still lost. Buyer B had something different. She had a fully underwritten TBD approval. TBD means to be determined. The property address is the only thing the underwriter hasn't seen. Everything else, tax returns, W-2s, bank statements, pay stubs, credit, has already been reviewed by an actual underwriter, not a loan officer, not an algorithm. The underwriter signed off, subject only to property-specific conditions. A satisfactory appraisal, clear title, acceptable property type. The borrower's creditworthiness is already done. Annie Mac said it directly in 2026. In competitive markets, listing agents ask who the lender is before they finish reading the offer. A letter with an underwriter's name on it removes the seller's single biggest fear, that this deal falls apart in underwriting. And when that fear is gone, a seller will sometimes accept a lower price or a higher one because certainty is worth something. NSMN Mortgage put it simply in July of 2026. A pre-approval gets you shopping, and a fully underwritten file helps you win. That's the whole video in 2 sentences. Now, the trade-off is real. This takes more time. Full documents up front, several business days for underwriter review. And it's still not a closing guarantee. Appraisal, title, and final income verification still happen. But the part sellers are most afraid of, the part that kills deals, is already resolved. That's why buyer B won at a higher price. She didn't outbid, she outprepared. Okay, 5 traps, all the way through, and you stayed, which means you're going to do something different than buyer A. So here's the refrain. The letter is not the approval, it's the starting point. Buyers treat it like a finish line. The adversary isn't your lender. It's reflexive disclosure, weak letters that look strong, rate volatility nobody warned you about, and an expiration clock that runs out right when you need it most. So before you submit any offer, call your lender and ask 2 questions. Can you customize this letter to match my offer amount? And what would it take to get a fully underwritten approval? Those 2 questions separate prepared buyers from everyone else. Please like the video and subscribe to the channel. See you in the next one.